TJT Capital Group's approach to tactical asset allocation. To understand TJT Capital Group's approach to tactical asset allocation, you must first understand and appreciate the fact that there are cycles to virtually every asset class, including stocks, bonds, commodities, real estate, and currencies, to name a few. Booms, busts, and human nature have not changed over the centuries. Long-term, upwardly trending cycles are referred to as bull markets. For example, the Dow Jones Industrial Average rose an incredible 1,409% from 1982 to 2000, one of the greatest bull markets in history. In the decade of the 2000s, the price of gold rose slowly and steadily from less than $300 an ounce to more than $1,900, a gain of more than 500%. Unfortunately, due to the nature of cycles, even long-term secular bull markets do not continue indefinitely. The Dow Jones Industrial Average has had two significant declines over the past 12 years, with the Dow falling more than 53% from October 2007 to March 2009. Long-term downwardly trending cycles are referred to as bear markets, which can be unrelenting and destroy wealth. We believe it's imperative that you make every effort to reduce exposure to markets that may be entering or are in a bear phase. The Japanese stock market, as represented by the Nikkei 225 index seen here, was down more than 75%, roughly 22 and a half years after its peak in 1989. The chart of the Nikkei 225 stock index shows how it's fallen from almost 39,000 on December 31st, 1989 to less than 8,600 as of late May 2012. A number of investors are well aware of the contributions of emerging markets to the growth of the global economy. However, TJT believes many of those same investors would be surprised to know that China's Shanghai Stock Exchange Composite Index, as seen here, has declined more than 60% from October 2007 to May 2012. After trading as high as almost 6,100 nearly 5 years ago, as of late May 2012, the Shanghai Composite stood in the mid-2,300 range. While China has experienced rapid economic growth over the same time period, this illustrates an extremely important tenet when it comes to investing. The stock market is not the economy. Sideways or range-bound markets generally consist of shorter-term or cyclical bull and bear markets, which require investors to be more nimble in their approach. As you can see in the accompanying chart of the S&P 500 index, the last two cyclical bull markets since 2003 have produced gains of more than 100%, while the two cyclical bear markets since the year 2000 have dropped, on average, 53%. Unfortunately, for those who have bought and held, the S&P 500 index, as of late May 2012, was at the same level it hit back in 1999. Buy and hold investors have generated zero wealth in more than 12 years. A study of the history of bear markets suggests a general pattern that we believe would be helpful for investors to keep in mind. In observing 19 major bear markets, almost invariably, after a significant decline, a powerful rally usually develops. However, following that initial rally, the market has a tendency to trade up and down in a range over a period of many years. Recognizing this historical experience may help investors in the future. Many investors are unaware of the fact that sideways or range-bound markets have occurred frequently over the years. This is not a new phenomenon. For example, the Dow Jones Industrial Average traded at a level in 1974 that it had previously reached 16 years earlier. And in 1981, the Dow was less than 1 point higher than the 1964 closing price. The S&P 500 index traded at a level in 2009 that it had reached in 1996, nearly 13 years prior. And in late May 2012, the same S&P index traded at a level it had reached in October 1999. This range-bound market can also be seen in the NASDAQ, where the low in March of 2009 was at nearly the same level it had achieved in 1996. This occurrence is not limited to just stocks. The price of gold, for example, was at the same level in 2002 as it was in 1979. And some New York City real estate, if you can believe it, was selling for the same price in 1974 as it was in 1929. To summarize, there are cycles in virtually every asset class. Therefore, understanding where you are in a cycle can go a long way towards helping you manage asset allocation. TJT Capital uses a proprietary risk management model that, to use a simple analogy, is much like a traffic light to help us with our tactical asset allocation. That is, when we believe the light is green for a particular asset class or market, we will generally go on offense and increase exposure. If we believe a market is signaling a yellow or caution light, we will generally reduce exposure or tread more carefully. Moreover, a market effectively eliciting a red light will cause us to generally become defensive, raise cash, and look to preserve capital. As we have tried to illustrate, there are cycles in virtually every asset class. Generally speaking, there are bull markets, bear markets, and range-bound markets. When you consider these three types of markets, a buy and hold strategy would not be optimal in 2 out of the 3 scenarios. And therefore, you can appreciate why we believe the buy and hold advice is wrong. Given the actual performance of the stock markets, real estate markets, commodities markets, and currency markets over the past 10 years or so, it's shocking to us that there are numerous people still espousing the notion that the markets are efficient. Suffice it to say, there is a wide gap between standard financial theories and real-world realities. As such, TJT Capital uses tactical asset allocation to customize portfolios and increase and decrease risk exposure accordingly. Please contact TJT Capital Group to learn more how we can help you manage your portfolio.